Hello. Hi. Thank you so much for coming. Thank you. Um, just give a minute for people to log in. Um, is Daniel on the line? I'm not sure. Like I see the surname Slider. I think that's Daniel. I'm not sure if you can hear me or not. Um, okay, I'll just assume. Okay, I wanted to kind of just talk a little bit for a couple of minutes. Something that Daniel said to me. Maybe if he gets to watch this afterwards, he can kind of see what my thoughts are on this. Essentially, um, you know, when you are investing, there are periods where uh, stocks don't work out, and there are periods where stocks are not working out temporarily. And I'm not going to say that, when something is not working out, it's necessarily going to come back. But I think that it's important to understand. So, Daniel's comment is there any way to kind of figure out what should be a reasonable amount of volatility for certain stocks? And, you know, the example that I think I was kind of preparing for this, I was thinking about it is, for example, the volatility of Money Lion, which is a stock I think that Daniel owns. And, I think that he's down, I don't know, like 45% on his stock. And he said, like, oh, how could I tell beforehand that the stock was going to be volatile? And it's really difficult. For example, when I first recommended Money Lion, it might have been October of last year. Or maybe November, I can't remember. It was around $18, and that stock was going very slowly each day, up, 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 up. Like it went into 20 to 22, 25 to 30, 35, 40, 45. Then it kind of continued going, and it kind of reached the one point like $70. And it was just so like a ruler. It was just kind of going up and up and up and up. And then they had the Q2 results, and the market did not like that. Management said, "Oh, we are going to take a different approach. We are going to increase our growth and cut back on our profitability." And this is something that the market detests. The market hates it when management says, we're going to invest for future growth. If you're a rapidly growing business and you're highly unprofitable, and the market takes you at face value like that you're highly unprofitable, but growing super fast, everyone's like, okay, no problem. Invest for growth. Take as much growth as you can. At some point, the market will, quote unquote, ask you to check in. A classic example of this was Amazon. They used to have this thing where once every 5 years, they kind of check in with the streets, like to say, and they kind of improve their profitability, say, oh, we can have really high profitability if we want to, but we choose not to. We invest in for growth, and then for another 4 years, just pedal to the metal growth rates. Now, so long story short here is that you're never going to know the volatility of a company. It's really, really difficult. And there's a quote from Buffett that says, given the choice between having a smooth 12% or a bumpy 15, I prefer to take the bumpy 15. But that's Warren, and the vast 99.99999% of investors would much rather take the smooth 12 or even the smooth 8 rather than the bumpy 12 or bumpy 15. They may think that they want the high returns, but they don't. What they want is an easy life. And it's really difficult because I'm so passionate about investing. And for me, I feel like, I would much rather just deliver the outperformance because for me, it's really something that I'm passionate about. And there are other people that deliver other services that say, okay, I'm just going to deliver a very, very smooth 8, 9, 10%, whatever they feel that they can deliver. But that's not something that I'm passionate about. I really want to try to drive our performance. But of course, there are periods like there was in the summer that they were really brutal. There are those periods. And I don't know how to avoid those periods. And I've definitely thought about it a lot. I've definitely been beating myself up about it since like the summer. The worst thing is when I recommend a stock, it goes up and then it round trips, comes back down. That's the worst. Because people get really excited when the stock is up. And that's the time that they want to invest. They don't want to invest when it's really, really volatile and untested. They want to invest when it's clear. A good example of this is PayPal that I wrote about today. For like 9 months, that stock goes up, down 20%. Like bang, 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 and then kind of takes off. And, it's been brutal. And that's why I don't like to use stop losses, because if I'd use a stop loss, when would have been the good time to get in that stock? When? I can tell you in hindsight, but it's really difficult. And I'm definitely thinking about, removing those outlier results. For example, I discussed many times, like with Uploving that was up more than 150%. Palantir, I'm trying to remove those like really kind of large home runs and just cap things a little bit more to kind of really to steady the journey, because at the end of the day, like I drive a subscription service and I need people to buy into the message, really. At the end of the day, that's the game that I'm in. It doesn't matter ultimately if I reach my destination. I need people to reach the destination with me. And that I need to take the feedback that people give me, that they much prefer to maybe have slightly lower returns, but actually get to the destination. So it's kind of like that, because when the market is hot, all the people ask me, like consistently ask me, is like, what can I buy now? Like, what is exciting to buy now? But when the market kind of goes through these risk-off periods, like we're having today, people say, "Oh, I'm going to wait for a better time," and I'm constantly thinking about how can I juggle that, and ultimately I have to follow my vision. At the end of the day, I've always said that, not always, but I've said that I would deliver our performance in 2024, and this is what I have to do. That's my vision. I have to do that. And as much as I try and accommodate people's feedback, I have to kind of go with that vision of reaching the goal. And this takes me to the next aspect that I want to talk about is I have found that the best way to have a rewarding performance in a year is when you take investments not with the idea of how much money I can make. Anytime that comes into the discussion is like, I know that person's going to lose that money. That's it. Anytime that's the first thought, the thought needs to be like, how do I preserve the capital? Because I've worked really hard. My family's worked hard. Everyone's made sacrifices to invest that money. I have a responsibility to preserve that money. Once that's the equation, once that's the starting point of the equation, it's actually a much more rewarding journey. And that's what I hate the whole topic of stop losses. I hate options, and I hate people doing stuff with margin or leverage, because those people, they like to talk about their winners, but when those bad periods happen, which they happen quite frequently in the market, no one's talking about it. And it's really important to have a more sensible approach and think about the businesses. Ultimately, we're all our investment is tied to the share price. I'm not denying that. But if the free cash flow continues to increase, the share price will follow that. Doesn't follow it every day, and doesn't follow it every month, and at times doesn't follow it even every 90 days, but it does. You can see that. You really can see that. So the game, I think, is really, I don't know if Chris is on the call here, and I'm not intelligent enough to figure this out. Let me just see if he is. No, Chris. Yeah, I think he is on the call. So he was discussing about PayPal, and PayPal is one of those investments. It's a bit like, in my mind, a bit like Robinhood, that there's a lot of negative press, but those investments with a lot of negative press, in my opinion, are actually the easiest investments, because you cannot focus on what you know about a company. You can only think about what the future investor will think about the company. That's really what it is. And in my experience, even to boil this down slightly further, what drives their performance is following really simple stories. The market loves simple stories. And those are easy. You don't have to have an opinion on like 100 different things. You just have to have an opinion on a few things, and you have to be able to distill that idea down to what is actually the core idea behind that business model. Really, I think that this is something that is really, the essence of investing is really how much can I dumb down the idea? Because when you say, I like this investment because there's this optionality and that optionality, and it's like those types of investments do sometimes work out, but it's really, really difficult to do. And I'm not sure that it's replicable enough. But, there are many different ways to invest in the market. There are some common ideas that I'm talking about, and you may take whatever you want from my ideas, adopt it if you want, or not. But, the common ideas here is that, and I hate saying this, but it's really not a get-rich-quick scheme. But this works. This really does work. And I know that is frustrating, like when there are periods like 6 months where things are not working out. But it doesn't always last. And even when things are not working out, that, don't squander that time. Like 2021, 2022 was really brutal for me. It was a brutal period for me. And I used the losses that I incurred in that period as my opportunity to learn, and reflect. And now things are like just so strong. This market is insanely strong. I mean, it's just mind-boggling. I was re-listening to some, investors talk and stuff like that from like 2022, and I was like, in 2024 there's going to be a bear market, and the economy is going to crash, and there's going to be a recession. I'm like, and it's just like just to try and reflect on what people were thinking at the time, because October 2022 was brutal, was really brutal, and that was actually like the worst period in the market. And from that point on, it was like just really easy. But it's important to reflect what were the narratives at the time. And I've come to the conclusion again that it's really important not to chase hot areas of the market. And by that, I mean, you can have exposure to that, but don't make your portfolio all about that. So, like for example, nuclear, in my opinion, is something that is really hot right now. I am a devout believer in this nuclear thesis. But I've been a devout believer for this for more than like kind of nearly 3 years now. So being too early is the same as being wrong. But even though the idea has finally come to be, I don't want more than 10% of my portfolio exposed to this idea because, tomorrow morning Trump comes in and says, oh, the hell with nuclear, coal is back, and, everything goes the other way. So you need to invest with some diversification. You don't need to have, in my opinion, you don't need to have 40 stocks because if you have 40 stocks, you don't know anything about those businesses. But you don't want like 25% of your portfolio chasing like AI or chasing like the hot idea because you will get decimated. You need to reach the destination. So I've titled this presentation Effing Up the Portfolio, and F meaning focus, bringing focus down. I've tried to shed a few positions in the portfolio so that I can enter this earnings season with a slightly more nimble portfolio. I've got a slot, free slots for three different new stocks. I will not be using all three. I will be using one, perhaps two in the next 2 to 4 weeks. I feel like, it's always the way that I describe having a little bit of cash on the side is like oxygen that, no one cares about it until you need it. When you need cash, it's like, oh my God, like you need to go. And you like, there's a like great idea. You can't dilly dally and, oh, like what do I need to kind of alleviate in my portfolio? And that's why I personally don't think that having, let's say, 30 stocks in the portfolio is helpful because they just end up being ticker symbols and they're like, oh, why is that going up? Why is that going down? Like like it's so difficult to control. And make it simple, make it easy for yourself. Don't have too many stocks and don't just chase. I particularly find that a lot, I don't know why, but maybe it's just the crowd that I kind of seem to hit around, but a lot of investors come from like a developing background and they try to kind of overcomplicate things and look for some kind of esoteric aspect of a business. And the market doesn't care. The market wants a dumb story to follow. And you just need to understand what is the dumb story to follow of that business. Like you need to understand what is the market caring about in that particular investment. So yeah, that's kind of what I wanted to talk about for today. There's quite a few people on the call. If anyone wants to ask any questions, this is a good time.
Hey, Michael, this is Haji. Sorry for late join. Sorry for late join.
Thank you, Colin.
I
How
have a
you
question.
Okay?
Good. Thank you. I'm at work. Thank you. Appreciate that. I have a question. I don't know. I bet you guys mentioned about this. You were mentioning about the Meta sell recently,
Yeah.
and then this morning you said let's sell it. I mean, once again, like this is no judgment, okay? But I kind of feel that I personally, like attached with Meta, and I get a good profit over there, and I do respect your call, but I'm trying to, like to connect this with your idea when you say a buy, when you send us a buy ticker, you're saying that you guys may get, like the 2.5%. I mean, this is not you kind of officially, but I mean, I hear this through the chat, and then maybe a couple days later or in a week by another 2.5%. Is that reasonable if we apply this to the, like for the selling, or should we just sell it, like the right away, no attach, nothing?
Thank you for this question. I thought about that for a really long time, and I tracked my own progress over the years. And in my experience, I believe that I personally do better when I just get rid of it. I've done different kind of it's not a religious science, but I just feel like, I want to just get rid of it. But you're absolutely correct in what you said, that when it comes to the buying process, I put 2.5% down, and then I wait 4 to 6 weeks, and I put another 2.5 down, and I sit on my hands, for like a year. And I do this kind of blunt cut at the end. Particularly with Meta, that I feel like, okay, I don't want to go into this earnings report with it. I've been waiting, like really trying to get rid of this stock for some time. I feel like, well, I'll be honest, it hasn't delivered the returns that I felt that I could have delivered. I still have some time because I said, to get to $630 by, next summer. I'm, still got plenty of time there, but I just feel like I can do better. I feel like I can do better than that. And yeah, I recognize that a lot of people kind of have that familiarity bias with it, and it's such a easy story, right? Meta, AI, the share price up and to the right. I get it. I get it. I get it. I mean, I get it. I get it. But and I also, to make things even worse, man, the next stock that I'm eyeing up is a complete like opposite of that. It's not like AI, and it's like the share price is not up and to the right, it's actually down and to the right. So, and but when I'll just say this very quickly, that when I recommended Meta, I was swapping Meta for Google. I wanted to swap that, and 2 or 3 people wrote to me saying like, "Oh, Michael, you don't understand. Like, oh my God, how can you do this swap?" And I was like, "Yeah, I don't know, man. I just kind of feel like there's an easier path here, because the problem with Meta was that at the time they were over investing, but that has already kind of worked into the price. That idea has already largely transpired, that you have to invest capital expenditure, capex. You have to invest capex to grow the AI opportunity. So that idea has largely played out. So do I have anything new that I can bring to the earnings results tomorrow night? I'm like, don't know, man. It's a bit 50-50. Do you know what I mean? Do you know what I mean? Like, sometimes it's kind of like the risk reward is a bit asymmetrical, and it's kind of like you can go higher, but sometimes it's a bit more 50-50. And I'm like, I don't know. I don't know if I want that risk. You know what I mean?
Okay, I got it. Thank you, Mike.
Hi, Natalie. How you doing? I haven't seen you in a long time. Really nice to see you again.
Wait. Sorry. Yeah, hi. Yeah, I haven't. I was.
Really nice to see you. How you doing?
Nice to see you again, Michael. Regarding Meta, I just wanted to say I think I'm grateful for advice like sell. I'm just generally grateful for sell advice, because the only advice you ever get from the market is buy advice.
Yeah. For sure.
So I'd actually sold half of my position on Meta. I believe in Meta. I believe in AI. I believe in what Meta is doing, and I don't believe that Meta will crash tomorrow.
No. Yeah. No. Well.
So,
yeah.
Regarding volatility, I do want to secure my positions, so I do put stop losses, and have a lot of the stocks that you recommend.
Yeah, I know.
And so with Anovix, I had to put a stop loss. I sold everything because I got stopped out.
Yeah.
But then I bought back with a setback. I'm back in, and I made 10% on.
It is really difficult.
Yeah.
So thank you for bringing this up. Thank you very much. Okay, so 2 things. Number 1, whatever I say is my experience, and you take or leave whatever you want. That's the first thing. So I'm telling you, and no matter how passionate I am, it needs to work with you and resonate with you. That's the first thing. Okay, so let's just be upfront and clear about that. Secondly, in my personal opinion, it's much better, for example, for me to work with, let's say, LifeMD or Enovix or whatever, with a 50% loss into the earnings report and it blow up further in my face, than for me to say, oh my God, like the share price is down, like, oh my God, I better get out. Because it's never that finite with the market. You know what I mean? Like companies last a really long time for the, I try and pick out businesses that have a reasonably clean balance sheet and I think about that. So it's not that the business is going to like into this earnings report, it's going to just blow up. You know what I mean? In fact, for example, Venovix, or whatever, like the business may be, when the share price is already down substantially into the earnings report, that means people are already really fearful going in. So anything that the management can provide some clarity on, I would say 6 or 7 times out of 10, it's actually a relief. People are like, I can breathe, and things stabilize. And I've actually seen a stock that I'm looking at right now, that I'm looking to perhaps recommend. I don't want to name it, but I've actually seen that the share price kind of goes down into the earnings report, like down. It releases the earnings report and it just kind of, the floor drops down like 30%. And then 14 days later, 2 weeks later, it's like coming back up again. And now this company is about to report in the next 2 weeks or so. It's like actually higher than it was like before it dropped down, and nothing has happened. There's been no news. It's not a big company. There's been no news, nothing. It's just like it went down and out, blew up, and then with no news, 90 days later, it's actually higher than it was. So in my experience, I find that it's much better to react to the earnings, make a conscious decision to the earnings, not to the share price. The way that I summarize this is, if you take your cue from the share price, if you follow the market, you're going to end up tracking the market. You'll underperform. If you take the cue from the market, it's like, what should I do, Mr. Market, now? You're going to end up underperforming the market because you're like, what should I do now? There's always the next point. What should I do now? Is it safe now? And, I can't speak for your portfolio, obviously, and I don't know your conditions and whatever. But if a person has apprehension, because in the case of Enovix specifically, it's a business that is pre-revenue. So there's no revenues, it's just, an idea. They may or may not, in the back end of 2025 into 2026, start ramping up their revenues. They may or may not, okay? There's a question mark there. But, in this case, like, if you feel like, okay, well, this is a bit volatile, whatever, just reduce it to, let's say, 1.5% of your portfolio. It doesn't need to be the full 5. And incidentally, like, this is why I didn't want to recommend a business that's actually doing really, really well. And I feel like, whatever about it. Oklo, which basically makes a small modular reactors for the nuclear energy, I've been following this company and the share price, Hashi told me about it like last week, and it's up like 40% since I've been tracking it, but it has no revenues. So I was like, do I really want to put myself in that position where I've done with Enovix, where, okay, the market is hot right now, but I fast forward this 6 months and the market may not be hot because Elon Musk has tweeted something, like, because he's got no revenues. How do you kind of factor that in? So I think in hindsight, Enovix was a mistake that I got involved in it. I should have waited to the back end of 2025 when the revenues were about to hit. And that was a mistake. And going forward, I will try to go with these more kind of established businesses, and I don't care about the upside potential. I think it's much better to reach the destination. Like for people like you, like, it's much better to reach a destination because everybody's patient with investing while the share price is going up. But when the share price kind of starts slowing down, it's like, what shall I do now? And I don't want to be in a position where people are like, oh, what shall I do now? Yeah, so I think that, yeah, it's a work in progress, and I'm trying to improve the strategy because I need people like you to have confidence in my experience. And that confidence can only come from you picking out, let's say, 5 names from the portfolio, equally weighting them, and for you witnessing in your mobile app, okay, the 5 as a group are doing okay. That gives you confidence to pick out maybe another 1 or 2 names. But if there are names like Enovix where a person is like buying and then he kind of gets hit by a stop loss, that's like, oh my God, no, like I'm not going to stick around for the journey. And then they kind of come back in like in September when the Fed is lowering rates and things are looking better. So I know Vasilis, you had the hand up, just one thing I want to say. So when a person goes for a stop loss and you hit a stop loss, okay, so let's say, just for numbers, whatever, you buy at $10, it goes to 8, you hit the stop loss, you're at 8, your capital's down 20%. And the next position goes up 10% from that, okay? So you're kind of 8.8, let's say, dollars, whatever. You feel great about the new position, but your actual capital is actually lower than it had been before the stop loss. And often, share prices rarely go down in a straight line. And oftentimes there's a better time to kind of feel tiny patient. It can come back a little bit. And, it's about the capital preservation. Yeah, and just one final thing about like when to sell. I try my best to give people a price target of where I'm going to exit this position on PayPal. I say, okay, I think it's going to go to $100, so that people can make a judgment. Okay, for example, PayPal today is down 7%, and it's like around $80. And the person I think, okay, Michael's going to exit this at $100. Is it worthwhile me getting involved now at 80 when it's going to 100? And then the person can make that judgment much clearer. But when you say, for example, that, like it's a contentious business, but I like this business, Gear Technology, I think that it's going to go to $60 and I'm willing to buy at anything below 30. Like I think that I can see 100% upside here. It kind of gives you a bit more room to think about, okay, this is something that's worthwhile sticking around for a while. Or even like today, the Centrus reported, last night, Centrus Energy, that is like this kind of nuclear idea, the enrichment of uranium. That I say I've been very clear, like I will not sell at any price. That kind of gives people a bit more confidence. Okay, like it's worthwhile chasing that. It was a bit of a long answer. I hope that was helpful.
Can I just add one thing? I think it helps when you reinforce your positions and say, you wouldn't sell and it will go to this price or so, because it helps me, for instance, with setbacks when the stock price is going down to buy even more of the stock. And
I've tried my best to be as transparent as possible. I don't have a crystal ball, but I say, okay, listen, this is what people are thinking. Of course, I make mistakes, man. Like everyone makes mistakes in this game. But I try my best to say, okay, yes, it is bad. For example, with Moneyline, I explain, like, okay, this is what I'm kind of looking for so that people can see, like, okay, this is I want from Moneyline 15 million of free cash flow. So I can kind of say, okay, so people can track my words and say, okay, this is the variable that I'm looking for so that people can make a bit of better call there. By giving people enough transparency, they can build confidence. Hi, Vasilis. Do you want to ask your question?
Yeah, hi. I know we're a bit out of time, but thanks for taking the time. So before I ask my question, I should put a disclaimer that I already sold my Meta today after your article. And by the way, we're already up 25% since you first bought Meta, so I think it makes sense to retire it. It already delivered. But I wanted to just hear your opinion about something I was thinking before I read your article. So because of the US elections, I thought that the earnings would be expected to go up, especially as Meta is doing pretty good at advertisements. And do you think this is already priced in, or could it be the opposite, that it creates expectations like the ones I have, and then maybe if they're not met, it just creates uncertainty and it could drop?
Correct. So first things first, you got it. You got it in one. The US elections, massive advertisement. And it never matters what the company reports. They're going to report tomorrow night, beat on top, beat on the bottom. Nobody cares about that. What people care about is what the next 6 months are going to look like. That's what matters. And you have the comparables relative to this year, which were pretty high. So it's going to be tough. Okay, it's going to be tough, and I'm like, okay, it's more equally weighted that the prospects going forward. So with sometimes, if the valuation makes sense, it may make sense to revisit Meta 6 months from now when the comparables in 6 months are ugly, okay? Because the multiple will come down, people's expectations are more muted. This is what I did with Arista Networks. I waited until the comparables were at the ugliest so that I knew if I stomach through this for the next 6 to 12 months, it will come out of that and the comparables will look really good, and therefore that thesis will work out better. So did I answer your question? Was I kind of able to explain myself?
Yeah, I think so. Basically, if I understand well, it's probably already priced in, and then
Yeah, because
it also creates expectations at the same time. And because of the uncertainty, you would prefer to, I mean, maybe come back to it later if it still makes sense later, but right now.
Correct, absolutely.
Okay, I understand. Thanks a lot.
Okay. Well, thanks everyone for coming. Really appreciate your time. Hi, George. I'll just say hello to you.
Hi, Michael. Thank you.
Thank you. Okay, everybody. Thanks so much, everyone. Nice to see you. And it's
have a good
Cyprus.
afternoon.
Hi. Hello.
Thanks a lot.
Thank you, Michael.
Thank you.
Thank you so
Bye-bye.
much. See you soon. Bye-bye.
Thank you.